The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Well, it's good afternoon from London, where I'm joined by my colleagues at WisdomTree. Welcome to Pierre Debru, the Director of Research, and Mobeen Tahir, CFA, and Associate Director of Research at WisdomTree. We'll come to my guests in a moment. And WisdomTree is going to present on 5 themes that could move the markets this year. This event is being recorded, and I'm going to ask Mobeen to forward to my next slide, which contains the IBKR disclaimers. And as he's doing that, I'm just going to remind people of some housekeeping rules. As I say, today's event is being recorded, so approximately 2 hours after the end of today's webinar, please check your inbox for an email containing a link to watch the recording. We'll also place the recorded event later today on our YouTube channel so that you can access that and other previously recorded webinars, including a great one from WisdomTree a couple of months ago on batteries and harnessing the power of the energy transition. If you have questions throughout the session, please put them into the GoToWebinar question panel, and Mobeen and Pierre will address those questions at the end of the session. And I think that's about everything I wanted to cover. So I am very, very pleased to welcome my guests, Pierre and Mobeen. If you'd like to move the slideshow forward, I'm going to hand the microphone over to you guys and welcome you officially to the Interactive Brokers channel. And let's find out what those fantastic themes are. Over to Mobeen.
Thank you so much, Andrew, for the introduction, and thank you everyone for joining us today. 5 themes that could move markets this year. Now, how low can the price of an asset be? Is it 0? Can it be less than 0? Well, 1 year ago in April 2020, WTI oil prices crashed deep into negative territory. And this defied conventional finance wisdom. It even defied intuition. So lesson learned, theoretical risks can become real sometimes. Market moves don't always work in one's favor, but an appreciation for the risks can help investors make informed decisions. So how can we inform ourselves as investors in the coming months this year? At WisdomTree, we believe there are 5 key macro forces that may drive market moves for the rest of this year, which is what we are going to talk about today. So the themes are as follows. We've got sector and factor rotation. We've got emerging markets. We've got reflation risks. We've got a focus on the environment, and we've got disruptive growth. My colleague Pierre Debru and I will go through each theme in turn, outlining the macro thesis as well as the asset classes that are likely to be impacted by these themes. So to kick things off with our first theme, over to Pierre.
Thanks, Mobeen. So yeah, let's start with our first theme, which is the sector and factor rotation that has been driven by the cyclical recovery in equity market. So clearly 2020 has been a very eventful year, as Mobeen was mentioning just before. And we've seen in 2020 the fastest bear market in history in the first quarter. We've then seen one of the fastest recovery in the second and third quarter. And in fact, at the end of the year, the last phase of this very eventful year was a cyclical recovery that really started with the US election of with the US election and the election of Joe Biden. So maybe Mobeen, if you can go to the next slide. So looking at the first quarter of 2021, what we've seen is the continuation of that trend of that cyclical recovery. Clearly, the successful vaccination campaign around the world, in the US, in the UK, in Israel, has continued to improve the outlook for the economy globally. And also in the US, we've seen large fiscal stimulus, first with the 1.9 trillion US plan that has been passed in the Senate a few weeks back, and with the announcement of this huge infrastructure plan that President Biden announced last week. So following all of those news, what we've seen that the IMF, for example, has raised its growth forecast for the world a few times in Q1 after having been pretty bearish in 2020. And so all of those effects, all of those events have basically created an impact on the performance of sectors. And so on this slide, what we show the performance of the sectors in 2020 and the performance of the same sectors in 2021. And what we observe quite clearly is that the losers of 2020 are turning into the winner for 2021. If you look at energy stocks, for example, energy underperformed the market in 2020 by 47%. So huge underperformance from the energy stocks. But in Q1 2021, they have already outperformed the market by 19%, leading to basically catching up on what they lost last year already. If you look at financial underperformed the market by 19% last year, and this quarter they outperformed by 9%. If you look at banks, European banks in particular, last year they had to cut dividend, they underperformed strongly the market, but this quarter what we saw solid earnings announced for this sector as a whole and for banks in particular, and we've seen talks about starting again the dividend payment and so on. Now, on the other side of that spectrum, if you look at IT or consumer discretionary, those sectors have done very well in 2020. So 21% for consumer discretionary above market, 28% above market for information and technology. But if you look at Q1 2021, they have underperformed slightly the market. They still delivered positive return, but less so than the market. Now, it's worth mentioning as well that some sectors like utilities or healthcare have struggled in 2020, and they also have failed to rebound in Q1. Now, if we switch to factors like Mobeen just did, the story is in fact pretty similar. What we see is that value was a big loser last year. It underperformed the market by 20% just last year. But in Q1, starting in Q4 and in Q1 this year, it really started to pick up, and it has outperformed the market by 9%. The second big winner this quarter is really small caps or size. Size had a pretty tough Q1, Q2, and Q3 in 2020, but had rebounded very strongly in Q4 following the US election, bringing the year to basically flat versus the market. But what we see here is that size is now doing very well in Q1. Momentum on the other side is the factor that is struggling. It did very well in 2020 with plus 12% compared to the market, but now it is doing minus 6% this quarter. Now, if we look at similar to sectors where you had utilities and consumer staples that had not rebounded yet, you see that mean volatility and high dividend are factors that have struggled in 2020 with minus 13 and minus 16% versus the market, but they also have not rebounded yet in Q1 2021. For mean vol, it makes sense because mean volatility stocks or mean volatility as a factor tends to be very sensitive to interest rate hikes and tends to basically dislike when rates increase. And that's, of course, what we've seen this quarter, which explains the underperformance of mean vol this quarter. Having said that, if we look forward, March has been the first month in the last 6 where the cyclical recovery has really paused. So if you look at the performance of factors in March, they're a bit different from the performance that we've seen since November, with quality doing especially well and size really pausing in March. So looking forward with the new lockdown in Europe, there is a question mark of is that rotation going to continue or is it going to invert a little bit? So with that, I'll give it back to Mobeen.
Fantastic. Thank you so much, Pierre. So with all of that Pierre has mentioned, a lot has happened in the last year or so, and since March 2020, if we look at initially with the pandemic causing an implosion in markets and the subsequent recovery being such that it was a strong recovery in equity markets, but an uneven one. That raises an interesting question that will it continue to be uneven? How can investors recognize that opportunities might be coming from lots of different parts of the spectrum, and particularly in equities? You've got these value components that are coming back to life. You've got these growth components that are continuing to do well. Now, investors can conceptualize this particular conundrum, this question, in lots of different ways. At WisdomTree, we've come up with one particular way of conceptualizing this framework into an approach which is really built on diversity. So this is one approach that investors can take. And the idea of diversity is to recognize that performance can come from lots of different parts. Within a diversified framework that we are showing here, we are showing three core pillars. One core pillar is made of quality. So quality is an all-weather factor which tends to be built by companies that are profitable, and therefore they tend to do well in almost all environments. They tend to do well in downsides as well as upsides. Then there's this element of diversity with cyclicals, because we recognize that with a cyclical recovery happening in the global economy, there are lots of different parts of the equity spectrum that are poised to recover. Things like value sector itself, but also you have small cap, you have things like emerging markets that are poised to recover because of the cyclical upswing that is starting to take shape. And all of this can be captured in a diversified framework. Similarly, growth can actually coexist in a diversified framework when you have it as another pillar, as a third pillar of your equity portfolio. So within this particular approach, we have introduced growth, particularly as accessed through thematic exposures, which have done particularly well in the last year, but are poised to continue to be relevant and topical for investors in the years to come. Then the two things can actually coexist. So this particular framework is one that can actually encompass all of the different components that are quite interesting: quality, as well as diversity with cyclicals, as well as growth with thematics. So I did mention at one point emerging markets, and that really takes us to our third theme, which is the emerging market theme itself. Sorry, the next theme, I should say, the second theme out of our 5 themes. And emerging markets is going to be an interesting theme in this year as well. So there are 2 main things that we want to highlight when we talk about emerging markets in 2021. The first thing is the US dollar. Now, the US dollar is a core component of any conversation on the subject of emerging markets. If history is a guide, the US dollar typically goes through long cycles of strength and weakness. And we've seen that in the second half of last year, the US dollar depreciated quite meaningfully. Can it bounce back quickly? Possibly, yes. But historically, we've seen that the US dollar tends to be linked to the twin deficit. And the twin deficit is quite simply a combination of current account deficit and budget deficit. So current account deficit is the idea that you are importing more than you are exporting. So you would be in a deficit with your trade relationship. The budget deficit is if the government is spending more than it's actually raising in taxes. Now, at a time when we're seeing a lot of accommodation, particularly on the fiscal front from the US government, it is possible that that we might continue to see pressures on the budget deficit, and of course on the current account deficit. We've seen that even in the last 4 years, with all the policies under the Trump administration, the US wasn't necessarily able to narrow its current account deficit meaningfully. So those pressures are likely to remain, and those could continue to put pressure on the dollar going forward in the months to come. And of course, if the dollar is weak, that means funds tend to flow towards emerging markets, and emerging market companies tend to do better because their dollar-denominated debt becomes easier to service, and that's why there's this clear relationship between dollar weakness and emerging market attractiveness. The second factor is China. We can't talk about emerging markets without talking about China, and China was one of the few major economies last year that actually grew, while other economies like Europe and the US are still in recovery mode. China actually grew in 2020 and entered 2021 in a strong position. And China has also introduced this plan for 2021 to 2025. So entering 2020 is significant, because that means China can really go after those goals it has set itself for the next 5 years. And the goals are built on this idea of dual circulation. So China has pitched the notion of dual circulation as the cornerstone of its next 5-year plan. And the idea is that it wants strength in the domestic economy and also strength in its international ties. And what that means is the domestic economy needs to be strong. There needs to be growth internally, which we've seen certainly in the last year or so. But internationally, China has also been ramping up its efforts in terms of its trade relationships with its partners in Asia-Pacific region, with the European Union, and now, of course, we're seeing talks taking place with the US as well. So China is interesting, but if China is interesting, investors have lots of different options when it comes to accessing Chinese equities, right? And the interesting dimension to consider is this. When it comes to Chinese equities, there's one clear distinction to remember. There's the notion of onshore Chinese equities and offshore Chinese equities. Onshore are all those stocks that are listed on mainland China. These are typically A shares, and offshore equities are things that are listed on, say, the Hong Kong Stock Exchange, the New York Stock Exchange, and so forth. So listed outside mainland China. And investors have options. Investors have the option to either gain targeted exposure to just A shares, for example, onshore listed exposures. Say the FTSE A50 is one of those indices which tracks onshore listed A share type exposures. But equally, you have things like the MSCI China index, which is a bit more diversified, or the S&P China 500 index, which is also a bit more diversified still as far as its share class exposure is concerned. So different things can work for different investors, but options are available, especially with China liberalizing its markets to foreign capital. This is certainly one dynamic that investors can consider. And share class diversity is an interesting facet, because it not only gives you exposure to many big stocks that might be listed overseas, particularly in China. If you think about big companies like Alibaba and Tencent Corporation that are listed overseas, that's one of the appeal that one of the things that appeal to investors. But equally, you have currency diversity, because naturally some of these listings will be dollar denominated and some of them will be Hong Kong dollar denominated. Some might be Chinese renminbi denominated. So you naturally get that hedge as well. So that's one aspect to consider, but certainly emerging markets is a theme which we think is going to be interesting in the year ahead. So that brings us to our theme number 3. And theme number 3 is talking about reflation. Now, reflation when it comes to talking about reflation on the macro side, we recognize that there's a clear distinction between inflation expectations and actual inflation. So inflation expectations are something that can be observed from market pricing. Of course, actual inflation is ex post. It's something that is realized in the data, but inflation expectations can be gauged through market pricing. And here on the chart, we are showing US break-even inflation curves. Break-even inflation curves quite simply are derived from the difference between nominal rates and real rates. And they tell us what bond markets are pricing inflation to be at various points in the future. The shape of the curve is less interesting. What's more interesting for our purpose here is the level of the curve. And if you look at how the level of the curve has gone up in the last few months, we see that the blue line, which is drawn for the end of February, has actually risen above pre-pandemic levels as well. So the gray line is end of December 2019. And that tells us that at least on the inflation expectation side, markets are pricing inflation to rise. There are three macro factors to consider why it might be interesting for investors to consider about the risk of inflation. Number one, monetary supply is at record highs. The accommodation from the US Federal Reserve, if you look at this chart here, this is US M2 money supply. Really, it's just one of the indicators of money supply, which is telling us how much money has the central bank injected into the system. And clearly, the dark blue line can tell us that the money injected during the pandemic almost dwarfs anything that's happened historically. So that's one. On top of that is the second factor, which is the fiscal stimulus factor. We know that fiscal stimulus has already been introduced in the US, and the US is further ramping up its infrastructure spending to further increase its fiscal accommodation. So that's the second factor to consider. And the third factor to consider is pent-up demand from consumers. Now, consumers who have foregone a lot of spending during the pandemic so far, once things return to normal, we may see the notion of pent-up demand coming in and helping lift the economy. And that can, of course, create that pressure on inflation as well. So all of those things are interesting to consider. Of course, since the global financial crisis, inflation hasn't really spiked up significantly, but these forces are a little bit different compared to what we saw in the past. Since the global financial crisis, monetary policy was the major tool that was used. Now we're seeing fiscal policy being used as an added tool, and that can really go a long way in fueling inflation going forward. So what can investors do about it? And what are the asset classes they can consider? Over to Pierre to talk about that.
Thank you, Mobeen. When it comes to inflation or to reflation, I think one of the assets that really comes to mind straight away is commodities. I mean, commodities by definition, they see demand increase when the economy is expanding. They are used throughout the economy, and so the price of said commodity really tend to rise with inflation. On this graph, in dark blue, you can see the inflation over the last 20 years. And in teal or light blue, you can see the performance of a broad commodity index. And you can see that the commodity price have historically aligned quite closely with inflation. So there seems to be a link between inflation and the price of commodity, making commodities an inflation edge. Now, if we go to the next slide and we look further at this relationship, what we've done here is that we've calculated the beta between inflation and different asset classes over the last 30 years, so for a pretty long time. And if we start from the bottom of the table, what you see is that government bonds or corporate bonds, they have a negative beta to inflation. So they tend to perform negatively when inflation go up. And in fact, if you look at the performance of bonds over the full 30 years and the performance of bonds only when inflation was high, and we define high as 3% annualized or above, you can see that bonds, they also tend to perform less well in period of high inflation than they do over the full period. Now, if we move up in the table and we look at equities through the S&P 500, we see that there's a little bit of a beta to inflation, 0.5, but still the performance in high inflation months is less than the performance in the full period. But now if we start to go up and look at the first two lines in the table, we look at gold and we look at Bloomberg Commodity Index, so broad commodities, we observe that both assets have a significant positive beta to inflation, but also the performance of those assets in periods of high inflation is significantly better than for the whole period. So if you look, for example, at the Bloomberg Commodity Index, the performance over the full period is negative, but the performance only in months where inflation was high is close to 10%. So the difference between the two periods is very striking. And if you look at gold as an asset, it's the same thing. You have a 3% performance over the full period, but an 18% performance on average when inflation is high. So those numbers, they really support the fact that gold and commodities act as an inflation hedge, but from an investment point of view, they can also be considered an investment that should be considered for a period of high inflation. Now, in the next slide, I wanted to look at inflation or reflation from a different angle. What we show is that bonds have a negative beta to inflation, and they tend to do less well when the inflation is really high. In fact, the higher the duration, the higher that negative beta or this underperformance is going to be. Now, in this graph, what I wanted to look at the performance of different type of bonds in the last 5 months. So in the last 5 months, as Mobeen mentioned, we've seen a significant rise in inflation expectation, and we've seen a significant rise in US Treasury yields as well. And so if you look at the bottom of the graph, you see that the US Treasury as an index, so the US Treasury as a whole, have lost around 4% over that period. So while the 10-year US Treasury yield went from 0.9 to 1.7%, so gaining 0.8, the US Treasury index, or an investment into US Treasury bond, has lost 4%. But now, if you look at only short duration US Treasury, so in our case, US Treasury 1.3, which is US Treasury with a maturity of less than 3 years, the performance is almost flat, which means that because the duration is shorter, they have not been hit as badly by the rate increase. But what about an asset that has a negative duration? In the example here, I look at a short investment or short exposure to a US Treasury ultra long future, meaning a short position in a future that is indexed to US Treasury with long maturity, so maturity of 30 years or more. And what we see here is that this short exposure would have gained 50% over the same period, because if bond with positive duration tends to lose money when rates increase, then exposure with negative duration tends to gain money when rate increase. So that's also something that can be considered going forward. And with that, I'll let Mobeen start the fourth theme.
Thanks, Pierre. Right. Fourth theme, the increasing focus on the environment. Now, climate change, the energy transition, this is a theme that is expected to unfold over many years, if not decades. But it's something that is accelerating this year and becoming increasingly relevant for asset markets, which is why we have included it as one of the themes for investors this year. Now, there are, again, three facets to consider when it comes to the energy transition theme, the focus on the environment theme this year. The first facet is what's happening on the policy front. And we saw that when President Biden became elected on his very first day of taking over as President of the United States, he signed the US back into the Paris Climate Accord. This is partly symbolic, but it's a sign of things to come in terms of the leadership that we might see from policymakers, the US included, on this particular theme. So that's one of the reasons why we think this is particularly relevant. The second avenue is what's happening on the industry side. So here I've shown an example of Jaguar Land Rover, one of the top automobile manufacturers that has actually made the claim that they want to test fuel cell powertrains within 2021, and they actually want to electrify their entire fleet by 2025. So very audacious goal, but it's certainly the step or the shift that's happening in the industry, and it's happening very quickly. So policy is being supportive. The industry is certainly being supportive. And the third thing is consumers, the uptake from consumers as it relates to electric vehicles. And electric vehicles is just one illustration, one example of this energy transition theme. It's certainly something that's accelerating. The sale of battery electric vehicles we're seeing is on an exponential path. And while this is the historic trend, the forecast is that we might go from somewhere around 5 to 7 million electric vehicles worldwide today to somewhere around 300 million electric vehicles by 2040. And that we may even beat that forecast if the acceleration continues at its current rate. So policy is supportive, industry is really coming through, and of course consumers are responding as well. All of this means that this is very interesting for the raw materials that go behind this whole theme. So to build an electric vehicle, you need core components which start from raw materials. You need things like batteries. You also need a whole infrastructure surrounding electric vehicles to sustain the technology. So let me illustrate that with a few examples. Copper, for example, is a very interesting metal for this particular theme. The amount of copper needed in an electric vehicle is typically 4 to 5 times that that's used in an internal combustion engine vehicle. So while you may need around 20 to 25 kilograms of copper in a petrol or diesel car, you may need 80 to 90 kilograms in an electric vehicle. And you also need around 8 kilograms of copper in each electric vehicle charging point. Now, if we look at the example of Shanghai, where we mentioned China earlier, China is really ramping up its electric vehicle infrastructure program. The city of Shanghai alone intends to add somewhere between 100,000 and 200,000 electric vehicle charging points in the next 3 years. And we're talking about each charging point needing 8 kilograms of copper. And this is just one city alone. We know that all countries are likely to follow suit. Even in the infrastructure plan being introduced by President Biden, the $2 trillion, which might just be a first phase of many further tranches, we're seeing that a third of that might go into the transportation and electric vehicle segment. So certainly the infrastructure is going to be ramped up. Silver is another interesting example. Now, if there's ever a metal in the world that beats copper's electrical conductivity, it's actually silver. And that's why silver is used actively in electric vehicles. In fact, almost twice as much silver is demanded by an electric vehicle as a petrol or diesel vehicle. And that means that the demand for silver purely from electric vehicles could go up by 50 to 70% in the next 5 years, according to the Silver Institute's forecasts. Nickel is another interesting one. Now, what would make consumers take up more electric vehicles? Well, you would want electric vehicles to be more efficient and more economical. And nickel is playing a critical role within that, because nickel goes into the batteries that go into the electric vehicles. And nickel makes these batteries more energy efficient, more economical, and therefore gives these batteries longer range, which is critical for the adoption of electric vehicles. So all of these metals really are integral in helping this technology grow, and therefore quite an interesting dimension to consider, that when it comes to themes like electric vehicles, it's not just the automobile manufacturers that investors can consider. There's a whole ecosystem surrounding it that's also available as an investment opportunity. Let me pass that over to Pierre now.
Yeah, thanks, Mobeen. So as we just discussed, with this focus on environment comes the need for metals and industrial metal in particular. And so if we look at the long-term performance of industrial metals compared to the performance of commodities in general, we see on this graph that industrial metals have a pretty cyclical behavior. You can observe what happens before the 2008 crisis, during the 2008 crisis, and during the rebound in 2009. You can see that the blue line is very volatile. It has a high beta because industrial metal in normal circumstances tend to be in strong demand when the economy is heating up. You need copper for electric cables, you need aluminum, you need steel, and so on. Now, what we just discussed with Mobeen is that with this environmental focus, with this energy transition, the need for metal is in fact stronger. And so what we've started to see since 2015 is that the performance of industrial metal has been very, very strong. And you can see this shift at the end of 2015, where the blue line starts to grow faster than the gray line, when the gray line is almost flat. And this shift has been very, very strong last year. So you can see this blue line shooting up at the end of 2019. And if you just look at the last 1 year, the industrial metal index has gained 53%, when broad commodities have gained 34%. So that's significantly higher rise for industrial metal than for classical commodities, I would say. Now, on the second slide, it's another lens to look at this pickup of the environmental theme in investing. If we look at the thematic universe, so thematic funds, thematic ETF, WisdomTree splits this universe into 4 main clusters. So you have the clusters of themes that is around the technological shift. You have one which is around social and demographic shift, one which is around geopolitical shift, and then you have the last one which is around the environmental pressure and the climate change. And in this fourth cluster, if you look at all the ETF and all the open-ended active funds that are focusing on theme inside that cluster, so that could be electric vehicle, it could be battery, it could be clean energy. All of the themes, if you look at the flow recently, they have picked up very, very strongly. So if you look at October 2020, November 2020, December, and so on, you can see that the flows in those type of funds and those type of ETF have increased significantly. So this is a clear trend last year, but if you were to unfocus, if you want, and look at the flows over multiple years, you would see this trend has in fact been building over the last 3-4 years, and really has gained a lot of speed in the last 4-5 months. And with that, I just hand over to Mobeen for part 5.
Part 5 it is. Thanks, Pierre. Disruptive growth. Now, let me start here. 2020, growth clearly outperformed value yet again, and this was exemplified by the strength, particularly in the tech sector. Now, the definition of growth itself is something that's evolving. At WisdomTree, we certainly see it as something that's evolving from just a handful of stocks with good price momentum to things that are aligned with mega trends. And therefore, these are things that have a longer shelf life. And these are essentially thematic investment ideas. And that's one of the reasons why we think growth and thematic investing, things that are aligned with mega trends, all of these terms are becoming synonymous. So that's an interesting theme to consider because that's becoming increasingly topical. So to talk a bit more about that, I'll pass it back to Pierre.
Thank you, Mobeen. So yeah, so thematic investment, right? At the end of the day, they promise to harness the long-term growth by really turning structural, world-changing changes or world-changing shifts into compelling investment opportunities, right? We talked about electric vehicles. That's a massive change in our day-to-day life, in our everyday life. Also becoming an interesting investment opportunity potentially. And so what we see with thematics is that we are turning, the idea is to turn those change in the structure or in the organization of our society into investment theme. And the thesis behind those investment, of course, is that those change are going to happen. Like, we don't know exactly the way they are going to happen, but they are going to happen. And so the growth is going to be there, and therefore the investment should do well on the back of this growth. And so if we look at the thematic universe again, as I discussed before, we at WisdomTree we split that into 4 clusters, but then we subdivide this into 35 investment themes, and I put quite a lot of them on this slide, and I looked at the performance of those different themes. And what we observe is that they've done extremely well in 2020, as we can see in light blue. But what's interesting as well is that most of them, they've done pretty well in the first quarter of 2021 as well. And even if, as we discussed in the first theme, the first quarter has really been driven by the cyclical recovery, and stocks that have not been doing too well in 2020, like value stocks, like energy stocks, like financial, have been doing well in Q1. What we observe that the stocks that are in this thematic universe, that those stocks that are benefiting from those long-standing trends or mega trends, also manage to do well in that environment. So if you look at the top of the table, you see that themes around wellness or themes around sustainable mobility, so coming back to electric vehicle, or sustainable energy storage, which is like batteries, or even AI, robotics, all of these themes have done very well in 2020, and they are also continuing to do well in Q1 2021. And so on the last slide, I looked as well at the flows into those investment themes, and we can see first that the environmental pressure themes have gathered quite a lot of assets. You see the sustainable energy production, so around the clean energy theme, have gathered 8 billion in Q1 in Europe. But you also see that sustainable mobility have gathered 1.5 billion, sustainable resource management has gathered 1.3 billion, and so on. But you also see AI, who gathered 2.5, health tech with 1.8, wellness, as I said, it's a top performer in Q1 with 1.6, or robotics with 1 billion. So overall, all of those themes are gathering quite significant interest and quite significant flows from investors in 2020, but also in 2021. And so that's really a fifth theme that is really gathering pace and gathering speed as we go along 2021. And so with that, I think we can go to questions from the audience if you have any.
Thank you very much, Pierre. and Mobeen. That's an excellent presentation. So for the audience, I just put into the chat panel there. If you have questions, please enter them now into the question panel. Folks over at WisdomTree in London, how would you characterize the first quarter in 2021 markets?
Thanks, Andrew. Yeah, I can kick things off on that question. It's been interesting. The adjectives I would use would be nervy, a bit jittery. That's how equity markets have been, but it's understandable. Look, investors have had to deal with a lot in the last year. So I started the presentation with the idea that we even saw negative prices in oil markets. So investors have had to endure quite a lot. And it makes sense that investors are trying to make sense of what's going to happen going forward, what's going to be the stance from the US Federal Reserve. Indeed, Q1, the big story was the rise in US Treasury yields and how equity markets weren't particularly thrilled by that development. But there was this constant question that how is the Federal Reserve going to respond given the way the events are unfolding. But as we come out of Q1, as we've now entered Q, probably the jitteriness is going to settle, the nerves are going to settle, and probably investors might start focusing on some of these big themes that we've talked about today, and that might be the narrative for the rest of the year.
Thanks, Mobeen. Something you just said there reminded me, I mean, investors seem to be extremely resilient. I mean, it's very hard to kind of envisage, a worsening of the situation. So despite the persistence of the crisis, despite the fact that COVID infection rates seem to be picking up in certain states again, the S&P 500 hit an all-time high again recently. So how would you evaluate the situation, and how do you think it will evolve?
Yes, I think you've summed it up very nicely in that this investor resilience is really at the heart of this matter. Now, a lot of people talk about this disconnect between the economic reality and equity markets. Now, how can equity markets be at all-time highs when there's a global recession, when there's the economy has been hit by such a big shock? And that's where the idea comes in, that while economic data is like a balance sheet, right? It tells you what the state of affairs is on the ground today. Market prices are about the future. Market prices are a collection of investors' emotions, because when it comes to the future, we can't disentangle emotion from our expectations of what is going to happen in the future. And these expectations are built on fears and apprehensions, but also hopes and dreams. And based on all of this, markets then bring the future into current prices. And if equity markets have been resilient during this time of crisis, it means that collectively we markets and investors have been more optimistic than pessimistic, even during this time of crisis. And the hope is that we will come out of this. And that's really that really explains why equity markets can continue to do well even when the economic reality is rather bleak.
So what's about the US fiscal stimulus? How do you expect that to impact the global recovery?
Pierre, I know you mentioned fiscal stimulus. I'll start my response here, but please do jump in. Of course, fiscal stimulus is going to be pivotal because let's not forget, last year it was the fiscal stimulus that really helped lift equity markets when they crashed initially. But one major shift that we are seeing is this recognition from policymakers that it can't just be monetary policy going forward. Fiscal policy has to support monetary policy to induce growth in the economy, and that's one major shift that has been the consequence of the pandemic that the policymakers are introducing. But Pierre, would love to hear your thoughts as well on this.
Thanks, Mobeen. But I think you covered it. I think that's the shift from monetary policy to fiscal stimulus is critical, and we've seen that in the US big time. I won't say. In Europe, it's happening, but quite a lot slowly. But still, we've seen this EU bonds being created to support the economy in the EU. So that's also going to support the economy in Europe. So yeah, that would be my take on it.
Very good. So I want to take you back to, I think it was around 2002. It was shortly after I came to the US. I was working down in Florida, of all places. And I remember there was a phrase coined about the commodities supercycle. I think it was a couple of guys at Goldman Sachs. So I think they were talking about, potentially a 100-year cycle in a super cycle in commodities. So you've addressed that theme today, but how real do you think the commodities super cycle is today?
Thanks, Andrew. That's a great question, right? And of course, at WisdomTree, the idea that we might be in a commodity super cycle is something that we find very interesting. But we also take a pragmatic approach to it, because we recognize that there's a distinction between a bull run and a super cycle, and you don't want to get carried away prematurely, right? Broad commodities generally are certainly in a bull run at the moment. Certainly in the last few months, we've seen strong performance in multiple commodity sectors. So on the whole, we're seeing this bull run in commodities. But for a bull run to become a super cycle, you need something structural. You need something that is going to unfold over many years. And in the past, it's been rapid urbanizations, for example, in places like China, that's been the trigger for a commodity super cycle. Can it happen again? Absolutely. Yes, it can, potentially. We're seeing with new infrastructure plans coming in from the US. Biden is talking about their own Belt and Road initiative, like the one that China has, that could be pretty significant, that could create a super cycle in commodities. But where we do see a more compelling case potentially for the idea of a super cycle is in the metal space. And that's because a lot of the demand for industrial metals particularly is being driven by long-term trends, and long-term trends like electric vehicles that we were talking about earlier in this presentation. Things like the infrastructure spending will certainly ramp up the demand for industrial metals as well. The energy transition more generally with the shift to renewable energy is another source of demand for industrial metals. So all of these things are not just things that are transient phenomena for 2020 or 2021. These are things that will unfold in the years to come. So if we're talking about long-term thematic shifts, then such a conversation is more akin to the idea of a commodity super cycle. So we see a clearer case, certainly in some parts, like metals, but in other parts we are waiting. We may see that ags and the energy sector becomes part of a commodity super cycle. Maybe it's early to say at this point, but potential is certainly there.
Very good. So can you both see the questions coming in now? I just want to direct your eyes to that, if you can kind of peruse, but I'm going to jump in on a couple of them here. Maybe you can answer a couple of these. The first one's from June. What is your view on the dollar relative to the euro and the British pound in the next 10 years? Is that something you can address? There's a question underneath from Robert. He says that you touched on fuel cell technology. Could you expand on the potential of fuel cell technology in the future? And a third one I'm going to leave you with here. What kind of thematic products does WisdomTree offer? If you could answer that one, I'm not sure you can, but I'll toss those over to you as we look through the rest of the questions.
Sure, I can touch certainly on US dollar and fuel cells and maybe thematics. Pierre, you can talk more generally about the idea of thematics again if you want to share any thoughts there. Certainly on US dollar, as we were talking about earlier in the slide, in one of the themes when we talked about emerging markets, we mentioned that, look, the US dollar typically goes through long cycles of strength and weakness. Now, 10-year is a very, very difficult time horizon that's been asked over here. But certainly if we look at, say, the next 1 to 3 years, we can see that the US dollar might continue to face some headwinds, and that's because of all the accommodation that's coming from the policy front. We're seeing accommodation on the monetary policy side. We're seeing fiscal accommodation, and that's going to put pressure on the US dollar. So that's one. Europe and UK are already coming out of a very difficult situation with Europe having faced structural growth challenges for many years. Then there was Brexit uncertainty clouding both Europe and the UK, and of course now the pandemic. So there is potential that those economies and by virtue of those economies, those assets might breathe a sigh of relief as they come out of some of the uncertainty and all the headwinds they've been facing in the last few years. So in the short term, next year or so, potentially we see more headwinds facing the US dollar. 10 years down the line, wow, I wish I could say, but you know, you might even see if it goes through that cycle that after 1 to 3 years, the US dollar might start strengthening again, and therefore that 2 to 3 year cycle continues if you want to extrapolate over to 10 years. Just very quickly on fuel cells, fuel cell is being emerged, is coming up as a viable alternative to battery powered technologies, and it's an exciting one. If you're a car enthusiast, you follow all these what the automobile manufacturers are doing, and that's why I showed that example of Jaguar Land Rover. But if fuel cells pick up, there are still challenges that fuel cells technology face. The whole process needs to be efficient. You can't just have an energy efficient fuel cell driven car. The process for making the hydrogen that goes into the fuel cell needs to be energy efficient as well, which at the moment is a challenge for the industry. So if the industry is able to make it a viable alternative, there some cars are already running on fuel cells, but if it becomes widespread, then it could be very interesting for even metals like platinum, for example, which are actively used in these fuel cells. So something to look out for, and we'll keep an eye on Jaguar Land Rover and all these other manufacturers. But the final point on thematics, Pierre, anything you would like to add on that particular point?
Yeah, no, I just say that clearly thematic is a subject of interest for us at WisdomTree. We do look at it in detail, and we do write a lot of research on those topics. As you can see on the screen right now, there is one cybersecurity blog, one hydrogen fuel cell blog, for example, that you can see on the web on the slide. But for anything about thematic, I would just refer you to the website. You can see the address on the slide here, wisdomtree.eu. Go there and you'll find a wealth of content around thematics that we have written about in the last few years.
I think we're going to have one final question here from Ahmet, and unless you don't want to answer this one because it's a little bit off the beaten path, but I'll read it out. Do you think people lost their enthusiasm for the equities market after Bitcoin and the resurgence of other coins, cryptocurrencies? And is there a shift of market participants from equities to coins? I know it's a little bit out of the ballpark on today's themes, but would you care to address it, either of you, or not?
I can make a comment here. It's hard to say that markets collectively have lost interest altogether in equities, and they've shifted to these new assets like Bitcoin. Of course, Bitcoin presents itself as a new asset class, which many investors are considering. Investors are always looking for new opportunities, differentiated assets that can give them value in new and compelling ways. And in fact, we just mentioned thematics. Thematics is one dimension which investors continue to explore, and that's being explored through equities. So we don't see at WisdomTree that equities have lost their relevance in the minds of investors.
Very good. Final question then from Tirasit. Can the commodities super cycle hurt technology company earnings?
Interesting. So it depends, right? Like if the commodity super cycle is something that is driven by an environment where there's demand for more commodities. So remember, a commodity super cycle is if the premise is that major infrastructure spending is being done around the world on all these projects, and that's creating this new demand for all these metals, that should in theory generate more economic activity as well. So that should be pro-growth. Certainly infrastructure spending should be pro-growth, demand for commodities should be pro-growth, and if automobile manufacturers are aligned with these trends, for example, demand for more electric vehicles because there's more infrastructure investment going into this particular domain, then that shouldn't eat into their profits. The whole idea is how are companies positioned relative to these megatrends, and that's something that investors will need to identify and really access appropriately.
Mobeen, Tahir and Pierre Debru, that was a fantastic presentation. Well done. Thank you very much. And to all of the audience, if you'd care to look in the handouts panel in the GoToWebinar software there, you'll see a link to today's presentation, which you can download. So I'll leave the session running for a couple of minutes so you can download that. So thanks again to my guests over in London, Mobeen and Pierre at WisdomTree. I'll leave it to you to sign off, and I hope you guys come back and join me again for another wonderful presentation.
Thank you so much, Andrew. Pleasure being here.
Thank you very much.
Thank you, everybody, and we'll see you next time. Bye now.